Hi there, welcome to Nepi Invest and welcome to a standalone answer question video. And this is sort of aligned with my search for high quality companies because Vinhili has asked, is Celsius, CELH on the NASDAQ on your high quality company list? I have no idea. And that is what I'm going to find out in this particular video. I could also have a look at the screener, my high quality screener, to see if it does come out in that particular screener, and then we'll just have a look at the financials. But what I'm going to do first is have a look at this company. What does this company do? Now, for some reason, I knew Celsius makes drinks. Apparently, they make energy drinks. Now, I went through some of their products just to see if I would drink any of their products. And the first question, or the first answer to that would be no, except there was one product that I was interested in. It was this one. Celsius Live Fit Hydration Arctic Cherry Essential Electrolytes. That sort of product is very important, particularly after you've exercised, gone for a long run or long hike. Getting electrolytes is really important. People just think of water, but electrolyte replenishment is really important. So that's the sort of thing I will be drinking during and after a long hike. I do it after every single long run as well. Always drink, replenish my electrolyte. So that is the sort of product I'm interested in. I'm not sure if there are other products are electrolyte replenishing. They just mentioned Energy Plus, Essential something. Energy Plus, Essential Energy accelerates metabolism, burns body fat. I'm a little bit dubious about the last one. But anyway, that is what this company does. They manufacture drinks, lots and lots of drinks. And obviously, they must be quite popular. So what I'm going to do now is just go to Fiscal AI and just have a look at some of the metrics of this company to see whether it could be classified as a high quality company. I could have a look at my screener, but I won't do that just yet. Okay, so let's have a look at the revenue for Celsius. And what we're doing here is just having a look at the growth in the company. This is the first thing I look at, because if a company can't grow their revenue and or their earnings, then it is not going to be a high quality company. That's the whole point in investing in these companies. You want to see growth. You want to see your capital grow over time. And if a company can't grow the revenue, how are they going to grow over time? It's impossible, almost impossible. Anyway, so a very fantastic growth. In fact, I'll just say fantastic growth for Celsius. Look at that revenue growth. Over the last 10 years, 57.9% per year, 5 years, 74.6%, 3 years, 50.7%. Now, one of my wariness thing is, one of the reasons I might be wary about this type of company is how much of a trend is there when it comes to this company's products, and could that trend just simply disappear? This happens all the time when it comes to food and drinks. It could be trendy one minute and untrendy the next minute, and could that affect this company? Founded in 2004, so it hasn't been around for long, but that sort of revenue growth over a long period of time is quite impressive, and that has translated to the bottom line when it comes to earnings. In fact, earnings per share growth over the last 5 years, 111% per year. So we definitely have the growth. This company is growing quite quickly, but the question becomes, how can that growth continue? How can it? Okay. Next thing I always look at is margins. Gross margins 50.5%, operating margins at 8.1%. This is just a 1 year sample. I would assume that this company is probably hasn't been profitable too long, and they're probably piling most of their profit back into growth. That's what I'm assuming. Operating margins, I like that to be a little bit higher, but that's a 1 year sample. Now, I don't think the 5 year operating margins average would be above 10%. So this would probably not satisfy my high quality filter just because of operating margins, but I'm making an assumption just based off 1 year. Now, return on equity 2.8, return on invested capital 4.7, 5 year average. So definitely this company would not satisfy my high quality filter, because of return on invested capital, 5 year average is below 10%. I want to see that above 10%. Now, this is a 5 year average, and maybe in the last few years, return on invested capital and return on equity have gone above 10%. And we'll have a look at that in a second. P ratio 143.6. So the market is expecting some pretty significant growth when it comes to earnings. What else can we look at here? No dividends. That's not a shock. Not much debt. Debt to equity is at 0.4, and the market cap of the company is about $15 billion. Okay, and $1.67 billion in revenue. Okay, next thing I'm going to do is have a look. Income statement is not available for annual. I'm going to have to change a hotspot into my phone because for some reason, I don't know what it is. Fiscal AI is not working on the internet. So this internet, and then I have to, on this computer, just this computer, and then I have to hotspot into my phone or use my other computer if I want to look at Fiscal AI. I don't know what's happening. That's why it says it's not available when it should be. Okay, so let's have a look at, well, we know what we're going to see when it comes to revenue growth. That's a spectacular revenue growth over the last few years. In fact, this company had $17 million of revenue in 2015. So it's gone from $17 million of revenue to $1.3 billion. Now, have you looked at the last year? Revenue has not grown all that much in the last year. So a lot of this growth has occurred over a 2 or 3 year period. We'll say a 3 to 4 year period. Is that a trend? Is that a trend? I have no idea. But the lack of growth or the significant slowing growth in the last year could be the first red flag. Not sure if it's a major red flag, but it could be a red flag. But what I'm going to do now is have a look at the quarterly. So this is the quarterly numbers. So this goes back 3 years or so. Looks like there was not much growth in revenue. Then all of a sudden, in the last year, revenue has just popped up significantly. Why is that? There was a significant pop-up in revenue in 1 year. Is that an acquisition? I'd want to answer that question first. Why has there been a sudden pop-up in revenue in the last quarter? Is that what do you call it? Is that an acquisition? Okay, let's go back to the annual data. Now, this is not a surprise. I expected to see that. And we could also have a look at income where is it? Oh, there it is. For some reason, I thought it wasn't there. We'll have a look at consolidated net income. And I want to see if this company was or when it became profitable. And it looks like before 2023, this company was not profitable. There was 1 year it was slightly profitable, but the last 2 years, highly profitable. Now, the profit has come down last year, but that could be just a one-off. So it looks like this company has just become profitable. So we don't have much history here. So that's another reason why I would struggle to call this company high quality just yet, just because it hasn't got quite the history. It hasn't got quite the history that you might want to be looking for to own a company for the long term. So maybe if you're more of a risk taker, you could say, well, the company has hit the inflection point and it's going to grow significantly over the next 5 years. Okay, next thing I'm going to look at is, what shall we look at now? Oh, operating margins. In fact, we'll also look at gross margins as well. And we'll have a look at gross profit margins first. And what we're seeing here is gross profit margins are increasing. That's good. That's nice. That's nice. First thing I want to see here is gross profit margins at least not falling, and they've been rising. The other thing I want to see is operating margins. Are they above 10%? Or they are. So because this company was not profitable, operating margins were negative. So that's why last year, I'm pretty sure in the overview it says at 8%. In the last 2 years, operating margins have gone above 10%. So in another 3 years, or even in fact another couple of years, the operating margins will be probably on average above 10% per year. So again, we don't have enough evidence just yet that this is a high quality company, but it's getting there. Okay, so that's our margins. The next thing I like to look at is return on equity and return versus capital. Now, I'm just going to have a look at the last 10 years, but this is only going to be relevant for the last few years because they've just become profitable. And so really you can ignore, in fact, what I'll do is I'll get rid of return on invested capital. So return equity was generally below 100% because it was not profitable. 2 years ago, 167%. Last year, 57%. So pretty high return on equity as the company has become profitable. And I think the same thing is going to be true for return on invested capital. So it's up to 40%. 2 years ago and 22%. So this company just needs a little bit more time. And in 2 years' time, if I went through this process, had a look at revenue growth, operating margins and return invested capital, this company could satisfy my high quality screener, but not yet, because it's only had a few years of profitability. We don't really need to look at, I was going to say, we don't really need to look at P/E ratio because it hasn't really been profitable all that much. So if you have a look at the P/E ratio history, you're going to see a lot of lumpiness there. So it's really hard to look at the P/E ratio of this company and really assign. In fact, what I might do here is go forward. P/E ratio is like 155. So it's really hard to say whether this company is expensive or cheap based off some of these valuation metrics, just because they've just become profitable. I'm trying to think of one we could look at. I wonder if we do have EV to EBIT. Now, even then, it's hard because you can see there's some years over the last few where the EBIT has been negative. So it's hard to really gauge whether this company might be cheap. Now, because the growth has been quite spectacular over the last, say, few years, and the company has just become profitable, P/E ratio of 143.6 might look a little bit stretched, but the company could double, triple, quadruple their profit over the next few years, and that sort of P/E ratio may not look too stretched. So it's all about whether this company can keep on growing. So at this point in time, in answering Vin Healy, this wouldn't satisfy my high quality company just yet, but it has potential. It has potential. Now to the chart, and sometimes you can get a sort of a different view just by looking at the chart. Now, what we see with the daily chart right here is a lot of volatility. In fact, during 2024, the share price dropped from $100 down to 20. And this is what you typically do see for these type of companies, where it's really hard to gauge the valuation or even the quality. And you'll see these periods of time the share price will drop a fair bit. But the chart actually does look good. The daily chart does look good. It's turned around. And it looks like the share price did pop up when they released their results recently I'm assuming, 7th of August. Share price increased 17.3%. The chart does look good in the shorter term. Now, if you have a look at the weekly chart, I'm expecting this to be, So before 2020, not much happening there. There probably wasn't much interest in this company, and then the share price just went bananas. In fact, the share price went from $1.50 to $100 in a fairly short period of time, and then we saw the share price pull back. Anyway, so we don't really although if you include the 200-week moving average, if you just have a look at the weekly chart and include if you do assume this is a high quality company, that was a good time to buy when the share price did drop from 100 to down 20, because the share price has started to rally since then. Anyway, so maybe you could argue that. But for me, this company probably is not high quality just yet. It needs a little bit more time to prove itself. But if you're more a risk taker and you like their products and you think their products are going to keep on growing, well, not the product, but the company is going to expand, maybe their offerings, maybe this could be a nice little buy, but maybe just a touch too late. Maybe, I don't know. Still well off its all-time highs. Okay, that's all I have for this look at Celsius. And don't forget, I'm recording this video a little bit later than earlier than when you're watching it. So the chart is going to look a little bit different. Okay, that's all I have for this look at Celsius. If you do have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.